Cool. I'm Ryan Kiskis. I work on our startup business development team here at AWS. Basically, I'm here to give you guys a very brief, 15 minutes, not a lot of time, very brief intro to VC fundraising. Some of the things to think about, some of the pitfalls, some high-level things to keep in mind as you might be going through this process. I've attempted to start or run product at early-stage companies for most of my career. It's been a number of startups along the way. We've raised a modest amount of capital. I thought was pretty significant at the time. Numbers always grow. And fortunate enough to have a couple successful exits out of that as well. So I know a little, probably been in way too many VC pitches, so know a little bit of context, a little bit of things to share with you guys. For me, how many of you guys are at startups now? Anyone gone through the fundraising process in the past? Couple? All right, good. All right, cool. I don't know why you guys are here. I'm not going to tell you anything new. So, thinking about fundraising. The first thing to think about from raising from VC is do you actually need to be raising capital? This is sort of a bit of a joke, but often there's a tendency to think, well, I'm going to go raise venture capital, and that's going to be it, and then things are going to succeed. It's going to be great. What could go wrong? And I think the biggest thing to think about up front is actually knowing what you're getting into. Raising capital from a venture capital firm is like adding rocket fuel to your startup, and that can be fantastic. But you really only have two options at that point. You're either going to make it to orbit, which is what the VC wants to get, or it's going to end up more like this, which isn't great. There aren't a lot of venture-backed companies that turn into nice, fast, high-flying airplanes. They're putting a significant amount of capital to work in your business in order to get up there, get to orbit. That's their goal. So have that in mind going into this overall process. This is another thing to keep in mind. Once you're on that route, again, their goal is to get you all the way down through this funnel to be that unicorn startup, the $1 billion valuation. So this is a chart from CB Insights, who's a great provider of data on the VC industry. If you're looking into what firms to look into, trends on these space, great chart or great source to use. So they looked at 1,098 seed-funded tech companies and figured out how many of those actually go through, seed round by definition is the first round, a second round, a third round, fourth round, et cetera, of capital, and actually get to exit. And the numbers are, as you might expect, startlingly small. 32 of those 1,098, only 32 actually exited for over $50 million, which in itself was a very, very modest exit. And only 1% of them actually ended up in the unicorn status. So, you're going into this. Hello? There. All right, try that a little better. Sorry. You go into this process knowing that that's going to be the goal of your backers, and so be aware that that's what you're signing up for. You're signing up for this process. You're signing up for that goal. This is just a trend of overall amount of dollars flowing into the VC space for last couple quarters. This goes to Q3 2016. What's nice a little bit is it's actually stabilized a bit, and you can see over the course of 2016. For when there was a surge of capital going in, it made it easy to raise capital, but also expectations were very, very high. And now it's kind of stabilized a little bit the last year, which is actually healthy for valuations, healthy for everyone going in. Another thing to think about is that, basically any firm you go and talk to is, hopefully in the end, is going to write you a check. So you might think, well, money is money. But money just isn't money. You're not only getting the check that they're going to write you, you're getting all the resources of the firm that they could bring to bear for you. You're getting the relationship with the partners that you're raising from. You're getting the relationship with the whole rest of the firm. You're getting a whole host of other ancillary potential benefits alongside of a check for your business. And so it's important to really think about not only, hey, can I raise money here, but who am I raising from? What are they bringing to bear? How do I interact and work with those individuals? Really, those individuals. At the end of the day, this is people. These are relationships you're going to have for a while, and this chart kind of indicates that. So this is a breakdown of the number of deals done in various years, and the blue at the bottom is actually, I think those might be reversed. Yeah, those are reversed. Sorry about that. The blue on the bottom is the number of first-time deals. So number of deals that a VC does, and it's the first check they're putting into the company. And the yellow is the number of follow-on deals. So they're coming in, maybe they raised the seed or Series A. Now they're participating in your B or your C round. These are relationships that you're going to continue to have over years. That first check isn't just, out the door and then you're done. This is a breakdown of what maybe a typical equity pool might look like in a startup over time. So, a VC is coming in, they're putting capital in your business, they're going to take an equity percentage ownership of your business. So after, say, a seed or Series A type of round, the chart on the left is maybe a kind of typical breakdown. Maybe you have two founders, maybe you split your equity, roughly 50-50. A lot of reasons not to make it 50-50, but let's assume it's roughly 50-50. And let's assume your other investor is going to take a relatively modest chunk of 15% of your company. Over the next couple rounds, so as you raise Series A, Series B, Series C, each of those follow-on investors are also going to want to have their own slice of the pie, their own 15, 20%. That might be growing over time. So after, say, a Series C round, you look at where those breakdowns end up. Your founder 1 and founder 2, which are these red and blue pies over here, you're down now to 13% of the company. Other major investors along the way are going to be owning the majority of your business. These two, the purple and blue, are your probably later stage investors. They invested heavily in your Series B, your Series C. They together own a majority. And it's more likely that they've been working together for years and co-investing. They know each other. They collaborate. They work together. They now own a majority of your business. So know that going into this sort of thing, it's very likely you're going to have, hopefully, a slice of a very, very large pie, but still a much more modest slice than you might otherwise expect. So, a couple quick things to think about as you go through this process of thinking about, hey, what type of firm might I want to raise from? Who do I want to talk to? What are the right things to keep in mind? So I want to talk briefly about timing, looking at their portfolio, the relationship you're going to be establishing with this firm, and also a story to have in mind. Timing. Start early. The culmination of this process is a 30-minute, maybe a 1 hour, maybe a 5-minute pitch to the partnership of the VC firm, saying here's what we're proposing to do, here's what we're looking for. That is a culmination of months and months and months of work. Not only work talking to multiple firms, but building the relationship with those firms over time. It's extremely rare to walk into a meeting and walk out with any sort of commitment. Usually there's a process of diligence, looking into you, looking into your background, looking into your co-founders, looking into your space, to understand as closely as possible what's going on. And that will take months. It's more about networking. It's more continual networking. It's more, I meet someone in a coffee shop or I got an introduction to someone, getting to know them as a person over, a couple weeks or months to understand if this is the right individual to have involved in your business. One thing to keep in mind with this is there will very likely be an almost continual flow of requests for data, for financials, for your assessment of a particular sector. It's important to deliver on those. Again, you're building a relationship with someone. You want to make them feel good about what you're giving them, demonstrate your confidence, demonstrate your awareness of your space, but also be aware that it could otherwise swamp your entire amount of time if you're working with a number of firms. So balance how much time you spend on those type of data requests. Look carefully at the portfolio of firms that you're looking at. Figure out, not only, hey, are they at all interested in my space, what individuals actually at that firm are interested in my space. So, VC firms typically are comprised of a partnership of, from 1 anywhere up to 10, 20, 30 different partners. They've each got their own ideas. They have to get buy-in from the rest of the firm to make an investment, but they've got their own thesis. So someone might be focused on enterprise software. Someone might be focused on voice technology. Someone might be focused on consumer applications. It doesn't do any good to say, hey, I see that, Andreessen Horowitz funds a lot of companies. I'd love to talk to them. You have to know who within Andreessen is actually the person who might be most interested in the sector that you're coming from. Look at who else they funded. Are there competitors in their portfolio? That can go for and against you, actually. Competitors might mean if it's sort of an adjacent competitor or something relatively close, they've got an interest in a space. But you don't want a direct competitor in that portfolio. A lot of firms will tell you now up front, say, hey, you know what, I invested in so-and-so company. They're a competitor to you. It's probably not appropriate. But sometimes you won't. Sometimes they won't. And this is not going to be the firm. This is going to be you a week later when you realize that you just gave your business plan to a firm who backs one of your closest competitors. So do that type of diligence up front. I've gotten a number of requests from entrepreneurs to say, hey, I see you're connected to so-and-so firm. Can you introduce me to so-and-so? And look at their portfolio and see if they're directly invested in your competitor. It's probably not the wisest decision. So be upfront about that. The VCs have gotten much better about being upfront and not necessarily taking meetings, or at least making you aware that there are potential competitors in their portfolio. But dive deeply into their portfolio. There's a lot of great data there about their funding history, the size of rounds they're doing, what sectors they're interested in, to give you insights about where you need to focus your time. We touched on this a bit before. This is a longer term relationship that you're building. VC exits now are 5 to 7 years. The trend has been lengthening. You're going into a relationship that is going to be there for a while. It's not if you come in thinking, all right, I'm gonna start this and we're gonna get out. I'm gonna be sold. I'm gonna sell this business. It's relatively unlikely you're going to be able to find a VC who's really interested in that. They want to know there's an exit plan. They want to know you're interested in having the business be acquired, IPO at some point. But coming in and saying, I plan to flip this in 3 years, probably not the greatest foot to start out on. You want to come in with this approach that, hey, I am here to build a lasting business. I am here to build something that's going to be significant. I'm here to build something that's going to put a dent in the universe. I don't have a plan to be sold right now. It's not what I'm focused on. I'm focused on building the biggest, most successful, most impactful business I can. I'm looking for someone who is going to be a close partner with me on that journey, is where you want to approach that engagement from. Think about your story. Basically, you think about the amount of time that a VC actually spends cutting checks. It's on the order of minutes over the course of a year, right? And they may make on an individual, a fund overall or a firm overall might be making tens of investments, potentially hundreds of investments. Most make a handful of investments per year, but they might see thousands of business plans. And of those thousands of business plans, they may still see hundreds of pitches. And so you have to figure out, of those thousands of business plans, what is it going to be that makes me stand out? And if you're playing in any sort of area, any sort of sector that is interesting to the world right now, it's very likely that there are tens, if not hundreds, of other companies that have a very similar pitch. So you need to think really carefully about how do I make myself stand out? Is it a referral? Which is obviously a great way to think about it. Is there a particular twist to my business? Is there a particular twist to my story? My background as an individual, why I'm interested in this space? Is there a personal anecdote, a personal connection, something you can draw on to make you stand out of those thousands of plans? Put why you care about this in the broader context. So it's not just that I see that self-driving cars are really interesting right now, and lots of funding going here. I can see the way that business is going. Why do I personally care about this problem? What has been my involvement with it? And what's perhaps my unique vision on this space? How am I seeing things differently than everyone else is? Referrals are still far and away the best way to get your plan in front of a VC. This is really the currency of the realm for them. A lot of them now have submission forms on their website. It gets dropped in a bucket. It's sort of, once they get through all the other referrals they might get through their personal network, and they still get a lot of those significantly. So check out the team pages. Again, look for the individuals. Check out LinkedIn. Check out other social networks. Figure out how you might be connected, what personal connections you might have into those various firms. And then ask for that referral. How do you do that? So again, I've gotten a lot of requests that look something like this. I want to raise capital. Can you introduce me to some VCs? Maybe they've done some research. They know that there's some top name firms out there that look really successful: Andreessen, Sequoia, Benchmark, Greylock. Can you introduce me to someone there? Again, not really a great request. Who do you think I should talk to? There are on our team we work with thousands of VCs globally. That's a huge pool. It's not that big in the grand scheme of things, but it's still a huge pool. The ones I work with that I know, I tend to know the individual. I tend to know their theses. I tend to know what they're worried about. But I don't know the nuances of how your business might fit into their particular portfolio. And so doing that dive into really understanding their thesis and how it fits together and how your business potentially fits there is crucial. This is a much better example of a type of introduction request to a VC firm. So someone might come to me and say, "Hey, I've got a business. I'm working on some aspect of voice-related technology. Maybe I've got a better recognition algorithm. I found that Alexa Fund, they invest in very similar voice recognition companies. I've dug into their portfolio. I see there's maybe this This company here, kind of adjacent, but not a direct competitor, but very similar to what I'm doing. They understand the thesis. I see so-and-so on the team is blogged about performance characteristics of voice recognition algorithms. He's clearly got a deep passion for that space. Here's my 3-sentence blurb that they can consume in literally 2 seconds in an email, and the pitch that if they're interested, they get into. Could you forward that on? Make that as super simple. You've done your diligence, you've done your research, you know who you're reaching out to, you know what you're asking for, and you've made it very easy to pass that on, and very easy for the recipient to consume that. So, by the way, the Alexa Fund is a real fund. It's a fund that Amazon runs, investing in voice-related technologies for our Echo platform. So, and so we do get an increasing number of these as well. I think that's about it. I don't actually know where we are on time. Might have a couple minutes for questions. Happy to take any questions now, or I'll hang around here afterward to answer anything. So, thanks. I have 15 minutes to answer questions. Excellent. Perfect. Let's do that. Yes. Yeah. So as I mentioned, like CB Insights is actually a great starting point for that. Crunchbase is another great starting point. CB tends to dive a little deeper into analysis on particular trends. They do dives on particular firms, great data. If you need a quick search for just, hey, who invested in who and what amount, you can find that on sources like Crunchbase as well. Absolutely, absolutely. At some point, they tend to have to make it public. They have to register with it. Sorry, question was, do they want, so A, where do you find sources of data about where they've invested, and do they want to keep that private? Eventually, for any significant amount, they have to register with the SEC, so fundings go public. They may delay that. So it may be a couple months. I've seen also sometimes up to a year afterward the data actually becomes public, but it does tend to be there. Yeah. Sure. So the question was, what do VCs look for in founders, and what should founders look for in a VC? I think it's a nuanced question because every firm is going to have their own view of what they're looking for. Typically, honestly, they're doing pattern matching, right? They're looking for who have I seen in the past be successful, either publicly, I'll look at big successes, a Facebook, a Slack, an Airbnb, or I will look at my own portfolio and what I've seen. But there are a couple red flags that I'd say, things that they look for and say this is probably not going to be a fit. They're looking for folks who are very committed to what they're doing. They're looking for folks who have taken a leap. Are you still running your day job and hoping to do this on the side? Really, really tricky to do. Have you put some of your own resources to work? It's not. They're not necessarily expecting that entrepreneurs are fully able to bootstrap their own business. That's why they want to be involved. But have I shown them a commitment that I quit my job and I built a prototype on my own for 2 months, 3 months? I ran up 50 grand in credit card debt to try and make that work. Like those are flags saying that I really believe in this problem. This is what I want to work on, what I want to do. They're typically going to look for some experience in the past around a particular sector or something. So if you have no background in healthcare, life sciences, or self-driving cars, or enterprise security, and say, well, I see a problem here. I think I'd like to go and tackle that. It's going to be a challenge. So I've seen it work sometimes, but they tend to look for some of that experience. They're going to look. It certainly happens. It's rare to have single individual founders. Usually looking for a complementary team as well. 2 or 3 people up front. Know you've got some skills that will get you guys through the first couple years, months or years. What to look for in firms. So we always touch on some of the things to be aware of. But there are signs of health to look for. When was the last time they raised capital? Have they raised a fund in the last 6 months? Maybe they just raised a fund last month. That means they've got a bunch of capital to put to work. They're very eager. If they raised their last fund 3 years ago and they haven't made a new investment in 6 months, they're probably out of capital. They probably don't have any more to invest until they raise their next fund. And so probably not so much worth your time there. Look for anything you can find about how a partner has interacted with their portfolio. A lot of them blog, like VC blogging has become extremely popular now, and so you can find a lot about what someone is posting online. If you know or you feel comfortable reaching out with other entrepreneurs in their portfolio as well, that might be a more casual, more easy way to get some insights there, and just ask, what has the experience been like? Have you enjoyed working with so-and-so at this firm? It may also be a good way to get that intro referral. A lot of referrals come from the founders in their portfolio and who those founders respect. So a couple things to keep in mind. Yeah. A deck of slides is usually sufficient. So in the nature of your business might be that there's a need for a certain amount of depth in certain areas, but it's usually not something that's written in, say, like a document form. It may be sort of comes through the diligence in your technology or your business process, whatever it is. So a deck is usually sufficient. I will say there used to be, there still is the elevator pitch, right? The conceptual, I'm going to run into this person in an elevator and I want to be able to convey in 30 seconds what my business does. The modern equivalent of that is really as I mentioned, like a 2 to 3 sentence blurb that can be put in email, right? And if you think about how you consume email, if you get a lot of email, you're opening up an email and you might have less than 2 seconds to get someone's attention. And they can consume 2 to 3 sentences in a couple seconds. And so that hook is actually probably one of the most crucial things to think about and craft and hone to catch that attention, to hopefully have them open up the attached deck or the link to the deck wherever it sits. And there are some very typical formats. I can point you to some as well, very typical formats of what that looks like. There's a lot of good examples of what a typical good pitch deck looks like now. So, sure. Yeah. Do you have any tips for fundraising if you're not located in the Bay Area? Well, first of all, look where are you located? Montana. Okay. Not a lot of VC firms in Montana. A lot in Utah. And a lot in Seattle. So the first thing I was going to suggest is look local as well. They are getting much more distributed. I would start, one thing to potentially start with is, we're talking about like Crunchbase, CB Insights, data sources. See if there are firms that have invested in your area as well, even though they are remote. There actually are some firms that are actively interested in finding, even though they may be based here, maybe based elsewhere, but based here, actively finding investments outside of Silicon Valley. A lot of them, a big chunk of them will stick to their location. They want it here, they want to invest here, they want their companies here. But a lot of the others see that, there are challenges with starting and raising companies here. Valuations are high, difficult to attract talent. Actually, there's some really interesting opportunities elsewhere. So see if there's local firms. See who might be invested over there. Might be firms to outreach to there. If you decide that the right firm, the right person to talk to is out here, you probably do have to come and spend some time here, right? And be able to say, like, hey, I want a budget, a week or 2 weeks. I'm gonna stay here. I'm gonna be available on short notice. Montana's not too far, you're close enough that if someone says, hey, can we meet tomorrow? You can get on a plane and be out here. So it's easier than, I used to be with AWS in Europe. That was more of a challenge. It's a little harder to get on the plane and be out here the next day. It's certainly doable. It just raises the challenge a little bit more for you. So, yeah. Of course, pretty much they only invest in AWS. Now, of course, it depends. I will. Oh, sorry. Of course. Yeah. So the question was, do investors look for, are you hosted on AWS, or what is your technology platform? I will say they're looking to tick the box on their level of technology diligence. It's going to vary widely, right? If you're building, software for enterprise applications, where you're hosted, what your deployment model is, that the sophistication, the actual capability of your technology is going to be crucial. Expect a lot of depth there. If you are building an on-demand consumer service, might matter a little bit less what that underlying technology stack is. I will say that AWS often gives, at this point now, it's been years of them seeing successful startups built there. They can tick that box. They're like, you know what? If you get a great article, or you're suddenly facing thousands, tens of thousands, hundreds of thousands of users, they know you can scale up to handle that, and it's not going to fall down. So, which is great, not to worry about it, but it's going to vary widely depending on what they're looking into. So, yeah. Yeah. How much IP should you have? Again, going to vary widely. I think there's a recognition that it's difficult for especially early stage companies to develop a deep patent portfolio or any patents. That might be different in some particular sectors. Take like healthcare, for instance. There might be a need to, or healthcare, life sciences, pharma, a need to have gone through a certain IP process prior to the point you're raising a significant amount of capital. But say for a typical consumer or even enterprise software application, not necessarily going to expect a lot there. They're going to be much more interested in what you have built to date. So whether or not that's actually protected, what have you built? How far are you ahead of the competition are you? And is that something that could be protected in the future, right? So when you're in your Series B, Series C, you're hiring up a set of lawyers, you're actually looking to be able to build that patent portfolio. Are you at a good enough starting place now that over the next couple of years, you're going to maintain that and be able to start patenting a lot of those pieces? So, yeah. Yep. They care. It can be managed, right? So I guess the one thing to keep in mind is that when, again, you look at the distribution. So sorry, the question was, do VCs care who's in the cap table? You mentioned a VC found you early. They wanted you to get in, wanted to take their money early, get in, have them a big chunk of the cap table, versus raising from maybe some more angels along the way, some seed funds, smaller bits, piecing it together. The two things to keep in mind. If you look at the distribution of returns within a VC portfolio, again, they're looking for those one or two companies out of the tens or hundreds that are going to be the unicorns that are really going to win, right? And so once they think they've found that company, they are going to want to put in as much capital as they can and double and triple and quadruple down on their winners. And the more people there are at the table jockeying for a piece of that pie, it makes it more challenging for them to get a stake that's going to be meaningful. It comes back a bit to the tables we were looking at there before, right? They want to, their model is that they're going to have 20 to 30%, if not more, of your company by the time it goes public. And so if there's just a lot of players there, it gets messy. If they're individual investors like seeds, angels, it can be managed. There's sort of an expectation that at some point you kind of are more lumping those people together into their own little investor pool, and there's room for a significant institutional VC to get the scale of ownership that they want. So it can be doable. There's always just that latent little risk of an individual who is involved there and they block it or they make it difficult at some point down the line, right? Manage to get through, I've got 15 individual angel investors and an institutional seed investor do my Series A. We get to ready to raise Series B. Great, we're ready to sign docs and everything. And you need every investor to sign off on that. And so individual investor is off in Fiji and can't be reached for 2 weeks. He's on vacation. Like suddenly you've got a legal issue to work through. So it just gets a little messy and complicated. So yeah. You can, yeah, exactly. You can deal with it. So it's those factors to worry about that I think is the big one. So they want to know that they can have a place for themselves and potentially, again, VCs also recognize they're playing in a relatively small pool. They've got to be friendly with their other co-investors. They can't edge out everyone entirely. They won't get in other deals as well. There is some collaboration, but it's a very closely networked community. As you'll find out. And so they'll just want to know who are they investing with, who are the other parties at the table. So, sure. Yeah. Sure. Yep. So the question is, what metrics do VCs really care about, particularly as they go to later rounds? I think it's a lot easier at later rounds because you actually, the term is traction, right? So what traction do you have and what metrics do you use to show that traction? It's really hard at a seed or Series A level. Your user growth is going to be relatively modest. The number of users you can talk to is relatively modest. You're probably not really going to have a lot of revenue, if any revenue. Your business model is unformed. That's really the challenging part to put together, like what metrics matter. And in those cases, again, they're much more about pattern matching of the founders, who are the individuals at the table. Do I believe in this space, right? Is there a wave that's going on that I can ride for a while, regardless of whether or not this business is the perfect one right now? You know, a turn of phrase that gets bandied about a lot is, I'd rather invest in an A-level team that's playing in the B-level space than a B-level team playing in A-level space. The A-level space might be great. That B-level team, they can probably ride that wave for a while, but the A-level team's probably pretty quickly going to figure out they're in a B-level space and figure out how to get into an A-level space. Let's get that right team. Let's get them in, working. Let's back them and stay involved, and they're going to figure out how to get from here to there. And again, for every business, it's going to be a little different. If you're building a consumer application that's dependent on social sharing, they're going to care about, what's your viral coefficient? What are your, cost of customer acquisition? What methods are you using now? How successful are those methods to drive that user growth? What is that growth on a week by week or day by day basis? Things like your daily active users, monthly active users probably going to matter too much or too early stage, but they'll look at what are those indicators of the growth of the business over time that are going to be successful. Series B, Series C, you're going to start to have real business fundamentals. You're going to have real revenue. They're going to be able to see revenue growth. They're going to look a lot at what are the difference between, my CAC and my COGS, my customer acquisition, and the cost of delivering to those customers. You can start to get a sense, it may not even be positive at that point, but is it going the right direction? Do we have a plan for how to get in the right direction? Basically start to look more and more like a real business that they can key off of. Yep. Yeah, 15 to 25% is a pretty good rule of thumb for every round. Is going to be what investors are going to be looking for. 25% would probably be at the high end. Seen higher sometimes, but probably be at the high end. 15% would be relatively at the low end. But a lot of times an investor, especially in an early stage, like a seed Series A stage, they're willing to perhaps accept a little bit less ownership up front, knowing that they're going to be the ones doubling and tripling down on the later rounds to get themselves to that ownership level. And if they feel that's what it takes to get into a deal, like it's a good lever they have to negotiate with an entrepreneur. To say, like, hey, I'm willing to take a little bit less stake in your company now, but maybe I want to be the only investor involved here, so that I know I've got sort of first dibs and right of first refusal and the rest on your next round. So. Yep. I mean, that ratio doesn't change a heck of a lot over time, right? It really kind of becomes how many more investors do you get at the table, and how much do they each want to maintain their own benchmark of, say, 15 to 25%, versus an understanding that, well, if there's four of us at the table, and we all want 25%, that's not going to work, and so you have to squeeze that down a bit. Am I willing to accept less because I've got the right people at the table? If I raise from say you raise early from a brand new fund, someone but they've raised a fund, they put some capital to work. Series B, you got the opportunity to bring in, say, a Sequoia. And they might say, like, I'm very willing to compromise my ownership stake to get Sequoia involved because I think it's going to be helpful for the success of the business. So. Individual angels or that sort of thing. Yeah. I mean, it's a little bit the stage you're at, right? And I mean, obviously, as you'd expect, and getting involved with an angel, it's an even deeper personal relationship. You even more deeply want to know that person. You want to know their network. You want to know what they're bringing to the table. You want to know how involved they can be. And that might be a mix. You may want to say, well, I want someone who's going to be super involved to help me out, almost be a co-founder in some regards. But maybe I don't want 5 of those people. And we're all jockeying and all giving me lots of different advice that I've got to parse and figure out. Maybe I actually want like 2 or 3 others who are, friends, network, someone I know who's willing to put some capital to work, but they want to be a more passive involvement there. So those folks, they should know. You'd want to know. You'd want to look if they've done this before. Do they know what they're getting into? A lot of those folks are going to get squeezed a lot as rounds go up, right? So let's say you get to Series B and you're raising $50 million. If they want to maintain their pro rata share, which maybe at that point is 5%, they've got to bring a couple $1 million to the table. Maybe they can't do that anymore. So that $200K that they invest, at some point that might tap out, and they recognize like, okay, I'm going to have a smaller and smaller piece. They should know what they're getting into on that. So you want to know so you don't burn bridges down the line potentially. So, yeah. Yeah.
Expectation for angel investors to do their pro rata in subsequent rounds now that seed investments are getting much larger than they used to be, and so pro ratas are have to be a lot more.
Yep.
A lot more on those investors. And then how is that signal interpreted to investors?
Sure. It's a good question, yeah, because the question was how much is expected that angels continue to do their pro rata over time, especially as rounds go up, and especially now as seed rounds have gotten more significant. I'd say it goes both ways, and the new investors are going to be trying to look at what the situation is and understand what signal that is sending, right? In some ways, as I mentioned, they don't mind that early angels are not going to continue to do their pro rata because it means that there's more and more of the equity pool that's available for them as a professional investor over time. So actually quite happy to get those folks squeezed down to 1%, 0.5%, something like that over time. Not having them participate at those later rounds is not necessarily a bad thing for them, nor a bad signal. You know, they recognize that, hey, this was an individual investor, and they may not have the capital to continue to play at that later level. But I think they look at the individual, right? Is this, hey, did I tap my rich uncle who wrote me a $100K check, or is this someone like a Gil Pincina who's like it's basically a professional angel investor? And if Gil's not continuing to follow on in my Series A after putting my seed round in, that's not a great signal. So because he's got the capital, he's got the resources to continue to back it up. I may still want to squeeze him down a bit, but I'd like to know he's still committed and backed in this business. Does that make sense? Cool. Yeah.
How do you trigger an agreement on the valuation?
It's always a negotiation. So you're going to be looking at benchmarks. So you can run a lot of these numbers, right? And so you can say like, all right, I know that they're probably going to be looking for maybe 15 to 25% of my company over time, and I know how much capital went into that. They raised $2 million. You can look at what sort of probably an expected valuation would have been based off of that. So if I'm putting in $2 million and I want to end up with 25% of the company, my post-money valuation is $8 million. My pre-money would have been $6 million. So you can kind of back into those numbers a little bit. You don't know exactly what those ownership percentages are if you're external. You're looking at other benchmarks. But again, you can use some of these rules of thumb to get a benchmark there. And then it is sort of that negotiation, back and forth. Again, because you kind of have the bounds of knowing what they want and what they expect, it gives you some overall guardrails, but where you kind of fall in there will be a matter of really the individual conversations. So there aren't usually a lot of business fundamentals to rely on, right? I can't look at your DCF and figure out like, okay, this is what your cash flow evaluation is going to be. So you kind of have to look at some of these benchmarks of what's expected and then figure out and fundamentally at the end, how interested you are, right? How much do you want that capital? And is it worth it to give up that ownership stake in your business to get it? So, any other questions? Anyone? Cool. Thanks, everyone. Hope you're helpful. Enjoy the rest of the show. And thanks for coming by.